You know what? I woke up this morning and I had an epiphany. There's a lot of good things going on in the world right now. I know there's a lot of propaganda. I know the liberal media wants you to be scared and wants you to think that everything's falling apart and that the world is ending. Well, that's not the case. As a matter of fact, the future is bright. But the future can't be so bright. There has to be some bad things that happen. There has to be some drama, some disgustingness. So you know what I decided to do? I was like, everything's going so well. Everything's bright. Everything's beautiful. I decided to taint myself a little bit and invest $500 into a private prison stock. I did. I bought a private prison stock. We're going to go check it out. It's called the GEO Group. And we're going to see if you can potentially buy in and reap massive rewards. Now, I know some people care about social responsibility and whatever. If you want to invest based on social responsibility, that's fine. But in my opinion, a lot of things like private prisons and basically a lot of things that are controversial, they're more complex than you might think, okay? The media and propaganda, they make everything come off as, oh, it's simple, cut and dry, Private prison's bad. But I don't know. I'm just always one that looks at stuff and I'm like, well, things are a little bit more complex than you can possibly imagine, okay? There's a lot more stuff involved. Anyway, I'm not here to talk about politics. We're here to talk about stocks. So let's go look at GEO Group. Let's go look at their website. Let's go look at their 10K. Let's go look at their valuation. And we're going to see if it's actually a buy. You ready? Let's go. And here we are, ladies and gentlemen. The GEO Group website. The GEO Group Incorporated, as a matter of fact. Who we are. Basically, they're like everything prison, okay? So they design, build, finance, and lease prison facilities, correctional facilities. They provide management and operations of the facilities, so like guards and whatever, freaking cooks, whatever. They run the facilities. In custody programs to, fix the prisoners. Transportation to move the prisoners around. Residential reentry, non-residential reentry, electronic monitoring. Now, I'm not an expert in the freaking prison community, okay? But they seem to be a pretty comprehensive, security prison company. So they seem to be pretty involved. Now, let's see what they actually do, okay? Or let's see where they're actually located. So they actually have a lot of locations. There's actually 57 U.S. facilities and there's 5 international facilities. Obviously, the vast majority of the facilities and the beds, because, you could have one massive facility and have a dozen others somewhere else, but the one facility is way bigger. The vast majority of the beds are in the United States. So although there is some diversification in this company internationally, it's mostly U.S. based. Now, let's go look at the 10K, and we're going to talk about some of the risks. We're going to talk about the management's discussion analysis. We're going to look at the financial statements, and then we're going to make a discounted cash flow model to kind of project when you should buy in. And it's all based on your discount rate and your assumptions. So let's go look at the 10K. We are now at the 10K, the company's annual financial report. Now, this 10K was for the fiscal year ended December 31st, 2020. Yes, there have been some quarterly reports afterwards, which you can go look at, but the 10K, the annual report, always seems to have, way more information that you can look at to assess risk factors, management discussion and analysis, etc., etc. But you still want to look at quarterly reports to kind of see what's going on, especially with a private prison company where there's a lot of heat coming from certain political parties that's really hammering stocks like this and potentially threatening some of their contracts. So let's go read a brief overview of their business. Now, there's only one thing I wanted to talk about with the business, because we already talked about it. They provide, facilities, they build facilities, they lease them, they manage them. We already talked about it. However, there's a very key thing you need to know is right now they are a fully integrated real estate investment trust. They are a REIT right now. If you are a real estate investment trust, you have to pay out at least 90% of your profits as distributions to your shareholders. Now, the reason that has to happen is that means the company in and of itself is not taxed at the corporate level. However, if you don't meet those qualifications, if you don't pay out at least 90% of your profits in dividends, well, guess what? You're going to have taxation at the corporate level. You're going to lose your REIT status. And there's benefits to both, okay? It's not like it's the end of the freaking world. They're no longer a REIT. But that's just something to keep in mind because they've actually suspended their dividend. We'll get into that, though. So let's talk about the risk factors. Now, when you're reading a 10K, you want to read the risk factors, okay? It's very important that you understand the risks to this business remaining profitable, continuing on into the future, all right? So what I like about theirs is they have a nice, delicious summary at the top, and then they go into detail about each one of those bullet points. Now let's look at some of the risks, and basically the risk I really want to cover are at the top, all right? The first major risk is this one right here. And it's small. You probably can't see it. I'll read it. On January 26, 2021, President Biden, our hero, signed an executive order directing the U.S. Attorney General to not renew Department of Justice contracts with privately operated criminal detention facilities because the government's just so much better. Two of the agencies of the Department of Justice, the Bureau of Prisons and the U.S. Marshals, utilize our GEO Group's services. Now, what does that mean? So basically President Biden issued an executive order to basically cut ties with private prisons. Now, it wasn't an immediate severance, but basically they're going to not renew any contracts that expire. The problem is a huge percentage of GEO Group's revenues come from the federal government. However, what I found hilarious is that even the president and his staff, they know they can't just cut sling load with these private prisons because they need help with, immigration surges coming over the border. They need to actually put people somewhere that commit crimes or whatever. They need the private prisons. You can't just snap your fingers and just make them go away. They need them. So the executive order only applied to the Department of Justice, the Bureau of Prisons, and the U.S. Marshals. It doesn't apply to ICE. Okay, you remember what ICE is? Immigration control, whatever, something like that. I don't know. I should know what the acronym is, but ICE, the guys that catch and deport immigrants, okay, or legal immigrants, excuse me. So the executive order did not stop ICE from using GEO Group contracts. So if Biden really cared about, private prisons being so bad, wouldn't he have ordered ICE not to do it as well? But whatever, it's politics. Anyway, so that's the big risk. Now, it's roughly 25% of GEO Group's revenues come from combined the Bureau of Prisons and the U.S. Marshals. So potentially GEO Group could lose 25% of their revenues, 25%, a quarter of their revenues, if nothing changes. That is the risk of a company being highly concentrated with one customer. In this case, the GEO Group gets more than 50% of their revenues from the federal government, of which 25% total is at risk because of this, okay? So that's one thing to keep in mind. This company could lose massive amounts of revenues, but who freaking knows? It might change the executive orders, or the next president will turn it over, or who knows? Things could change. I think this order was a virtue signal, meant to please, a specific base of the Democratic Party. All right. Next risk. Our level of indebtedness could adversely affect our financial condition and prevent us from fulfilling our debt service obligations. Now, GEO Group is in a lot of debt. Okay, their debt to equity ratio has been increasing, and they've been incurring debt to basically expand their operations. Okay, we have a significant amount of indebtedness. Our total consolidated indebtedness as of December 31st was $2.6 billion, which you have to put that in context. You can see that on the balance sheet. But basically, they're in a lot of freaking debt, okay? So the two main risks is this company could lose 25% of its revenues once these contracts are not renewed for the federal government because of the Department of Justice and because they're in freaking debt. Well, normally, if you're in debt, you can just refinance it, right? Well, there's a problem. A lot of banks, and it's somewhere else in here, a lot of banks are being liberal and amazing, and they're choosing not to refinance their debt. And I believe banks that provide 50% of GEO Group's financing have told GEO Group that they are not going to refinance their debt for political liberal purposes, whatever, because they're private prisons. That's a huge freaking problem, okay? They need to find a way to refinance their debt, because when their debt comes due, it matures. They need to either pay it off or they need to get new debt in order to pay off the old debt. So I think it's right here. 6 of our 65 lenders have indicated they will not renew their lending commitments to us when such commitments expire in 2024 because we are a private operator of secure correctional and detention facilities, processing centers, and reentry centers. Wow, you're saving the world. These 6 banks represent 54% of the lending commitments under the revolver component of our senior credit facility. So basically, a lot of their freaking debt, they're in a lot of trouble, okay? Which is why they suspended their dividends and stuff like that. So they go on, they talk about their indebtedness. Our borrowing costs and access to capital can be adversely affected by a downgrade or potential downgrade of our credit ratings. So not only could they potentially lose 25% of their revenues, see all the risks here is where the stock's sold off. On top of that, they might not be able to refinance a lot of their debt because 6 of the biggest lenders basically said, we're liberal, we can't lend you anymore. And if their credit rating gets slashed, well, their interest rate, even if they get to refinance their debt, the interest rate on their debt could potentially go up because their credit rating has been written down because they're in massive debt, losing revenues, etc., etc., etc. So they're really worried, or you should be worried if you're investing in this company, about some of the loans that are coming due in the next couple of years. That's something to keep an eye on, okay? Servicing our indebtedness will require a significant amount of cash. Our ability to generate cash depends on many factors beyond our control, and we may not be able to generate the cash required to service our indebtedness. Okay, so a lot of this is just, okay, are we going to be able to pay off our debt or not? Are we going to keep the contracts or not? That's the freaking problem, okay? That's what you need to worry about. Now, let's go look at the management discussion and analysis. So now we are at management's discussion and analysis of financial condition and the results of operations. That's a mouthful. MD&A. Okay, you can just say that. Jesus. Anyway, there's a couple of useful things in here. Now, they reiterate as a REIT, they are required to distribute annually 90% of our taxable income in order to maintain qualification as a REIT, which means they don't pay taxes at the corporate level. The taxes are passed down through to the shareholders. Okay, somebody pays the taxes. Don't get your feathers in a ruffle, Democrats. Anyway. But they recently suspended their dividend, which is actually in their quarterly report right here. On April 7, 2021, they have immediately suspended their quarterly dividend with the goal of maximizing the use of cash flows to repay debt, deleverage, and internally fund growth. Like I said, a lot of the banks are being nice and liberal, and they don't want to lend them money, and that's what they're concerned about. They're concerned they're not going to be able to refinance their massive debt load, which will screw them over. So they might not be a REIT for long, which means, well, first of all, you're not going to get those sexy dividend payments, maybe not necessarily. And number 2, they're going to be taxed at the corporate level, which means the corporation itself owes taxes, which, has a lot of consequences. Anyway, so let's look and see some of the important things I think you need to see here. Revenues 2020. So here you want to see the disaggregated revenues, which means they take the total revenue number, which was 2.3 billion in 2020, and they split it up so you can see like where the revenues are coming from, and you can see the trends, the changes in revenues. So for example, in 2019, 64% of GEO Group's revenues came from the United States, U.S. Secure Services. That's up to 67% in 2020. That's also the block that's most at risk because of the executive order from our delicious president. GEO Care, that's like their services with, helping prisoners get ready for outside, was 24.8% of revenue in 2019, and now it's 23.5%. International, 9.4 down to 9, and facility construction and design, 1.2% to 0.7%. So basically, it's a little scary there because 67% of the revenues come from U.S. Secure Services, and that includes state governments too. It's not just the federal government. The only real big concern right now is the federal government, but there's also contracts with state governments. If you go back to the map, if you go to the locations map, you can see there's prisons in California, Nevada, Arizona, whatever, New Mexico, Texas, Oklahoma, Louisiana, Georgia, everywhere. There's freaking prisons everywhere, okay? It's not just the federal government, but the federal government is a big part of it. As a matter of fact, 67%. So you want to look here to really see where the revenues are coming from, because that's how you evaluate the risks and, use that to project your future cash flows. So that's important to know. What else is important to know? So they actually talk about a lot of their debt here, which if you really want to get into the freaking weeds, I mean, okay. At the end of the day, if they can find new lenders to give them money, they're going to be just fine. That's the key thing in management's discussion and analysis. There's a lot of good information here. You can kind of read about all their debt, how COVID, the virus affected them, all sorts of stuff, which is very important. And they reiterate the executive order. There's a lot of good stuff. So if you're reading a 10K, you want to at least read the risk factors and at least read management's discussion and analysis, especially if you're going to put a lot of money in a company. I mean, I put $500 into it because I was like, it might be a good play, but I'm not, whatever. I didn't have to read this whole crap to invest $500, if you know what I'm saying. But let's go on and look at the financial statements. So now we're on the financial statements. The first thing we're going to look at is the consolidated statement of operations, the income statement. So if you look from right to left, it shows you the company's revenues and expenses and their bottom line profit from 2018 on the right to 2020 on the left. Of course, there's quarterly statements after this, so you want to look at those as well. Now, from 2018 to 2019, revenues went up by about $100 million or $150 million. And then, of course, in 2020, a couple bad things happened. The virus, number one, and then we found out that El Presidente Biden got elected at the end of 2020. So with the virus and the election results at the end of 2020, that probably had an impact on the company's revenues, because the Democratic Party, especially with a supermajority, well, not a supermajority, but they have the House, the Senate, and the presidency, that's all going to, cast doubt on GEO Group's ability. So they've had revenue growth over the last couple of years. We can actually look at we can go look at Morningstar. But revenue has declined in the last year, and that might continue, especially if those contracts aren't renewed. Operating income, same thing with operating income, went up by, $40 million from 2018 to 2019, and then dropped down by $80 million. Net income, same thing, went up from 2018 to 2019, and then dropped down. So this is bottom line profit by about $54 million. So 2020 was kind of a rough year. It didn't destroy the company. They still turned a profit because you need prisons, but it definitely had an impact, like it did on a lot of freaking companies. Okay. So at least we know they're profitable. At least we know there was revenue growth before the virus, and, the revenue drop wasn't significant. The only thing we're really worried about is Department of Justice canceling a huge percentage of their revenues going into the future and not renewing their contracts. Next, we're going to look at the balance sheet. So you can look at a couple things here. You can look at the current ratio, which you take total current assets, 711, pretty good place, divided by current liabilities, 411. So if it's over 1, which this is, they're not going to go out of debt anytime soon. The next thing, at least within a year, 2019 current ratio 541 divided by 395. So I mean, they have at least for the last 2 years, they've had a consistent history of having a positive current, or a current ratio over 1. Now, the next thing you can look at is total debt to equity, and you can see trends in that over time to see if the company is incurring more and more debt as a percentage of their assets. Total debt, which they actually don't have it on here, which is annoying. You have to calculate it. But you can take total liabilities and shareholders' equity, subtract out shareholders' equity, that gives you total debt. Then you take the debt divided by equity. So if we do that, let's see. So total debt is $3.5 million. Subtract out shareholders' equity. Divided by shareholders' equity. 3.89. That's pretty high debt to equity ratio. And it's been going up because you look at the previous year. It was 3.33. Now it's like 3 point whatever that was. So their debt is definitely increasing. That's a big concern with this company. All right, next thing, cash flows from operating activities. So one thing that was actually nice on this financial, or this 10K, is that cash flows from operating activities, what the business actually does, have freaking shot up over the last couple of years. 274 million in 2018, 338 million in 2019, and 441 million in 2020. So they have pretty healthy cash flows from operations, which is cash coming in from the stuff they actually do. Cash flows from investing activities, you can look at buying and selling equipment, capital expenditures, that's how you calculate free cash flow. And you can look at cash flow from financing activities. Now, one thing that tells me they're going deeper and deeper and deeper into debt is if you look at proceeds from long-term debt, that's money coming in, and payments on non-recourse debt or on debt in general, if the proceeds with money coming in from borrowing money exceeds payments, they're going deeper and deeper into debt. So in 2018, they paid $282 million of debt off, long-term debt off, and they received $502 million of debt. So they had a net increase of debt, and that's just from looking at the long-term debt of $220 million. The next year, they paid off $513 million of debt, but they took in $521 million of long-term debt. And in 2020, they paid off $816 million and took in $960. So you see that differential every year. That means their total debt is increasing because they're paying off less than they're taking on every year. Kind of sounds like the federal government, doesn't it? So that's that. All right, so now let's move on and look at potential buy points for this company, assuming different risks. All right, so the last thing we're going to look at before I close this video out, because old strongman's kind of tired. Can you tell I'm a little bit low energy today? I'm a busy boy. You know what I'm saying? I got crap to do. So, I didn't steal, but I used Everything Money's format for their stock analyzer tool. So what I do is I take the, I go to Morningstar, which I don't have up right now, whatever. I can download this spreadsheet from Morningstar. I paste it into here, and then it automatically calculates all these percentages for me. And then I can use it to kind of build my assumptions. Now with GEO Group, there's two ways you can approach this. You can assume that the revenues are going to stay the same, or you use the most recent 4 quarters of revenue and project that forward. Or you can factor in that the Bureau of Prisons, which is 14% of their revenue, and the U.S. Marshals, which is 12.7% of their revenue, is going to go away going into the future. Now, there's got to be specific points, and you can make this super accurate depending on when the contracts expire. But just to keep it simple, you could just assume, if you wanted, that the revenues are going to go away. A total of 26%, because that's what was potentially, or that is what is going to go away if that executive order from the president remains. Because we're saving the world. So, these are all the assumptions I did. And you can go look at it yourself, figure out your own freaking assumptions. But basically, the GEO Group, they've had revenue growth pretty consistent over the last couple of years. And it's only recently where they've been running into trouble because of politics. So, if you look back in 2011, $1.6 billion in revenue, and now we're at $2.2 billion, almost $2.3 billion in 2021. So, revenue over the 5 years grew at a 5% compounded rate, 1.27% over the last 3 years, 0.4% over the last 2 years, and declined over the last year. Will that change? I don't know, but the virus has something to do with it, and the frickin' executive order has something to do with it. So on your assumptions, you can say, okay, they lose 2% a year, going 5 years into the future, compounded over time, or the revenue stays flat, or the revenue actually increases by 2%. It could go either way. You really don't know. The next president could come in and say, screw that, we're keeping the contracts. You don't freaking know, so you have to use different assumptions. And you can be more risk averse if you want. Share change. So for share change, they have issued shares historically, and recently they stayed kind of flat. So there is the risk that because they're paying off a lot of debt and they suspended their dividend, they need to get out of debt, they may potentially decide to dilute. So I said, worst case, they issue 2% shares going forward. Best case, none. Profit margin between 4 and 6%. Now, that's been pretty consistent over time. It's pretty easy to see the range of profit margin. They had a profit ranging from 4.8% in 2011 up to 9.11. But over the last couple of years, it's been roughly hovering between high 4s and high 6s. So I said, you know what? 4, 5, and 6% seems pretty reasonable as profit margin going forward, okay? Free cash flow is a percentage of revenue. So free cash flow is pretty freaking high as a percentage of revenues. But I want to be conservative just because there might be a lot of free cash flow consumed with paying off, with increased operating expenses or paying off the current portion of short-term debt. So that may be an issue there. So I was conservative with free cash flow, and it is all over the place. So I said, okay, free cash flow, 4, 5, and 6%. PE, 8, 10, 12. I mean, that's pretty reasonable. You can even drop it lower if you want. And then a return of 15%. It's a buy for me in the middle assumptions. So if there's zero revenue growth, they issue 1% shares per year, profit margin of 5%, and there's a PE of 10, 5 years from now, I'm going to get a 15% return if I buy it right now. The stock's trading for 7%. That's assuming the revenue doesn't change. However, if you think all that revenue is going to go away, let's see what happens. Minus 100, times 1 minus 26.7%. So basically I adjusted the revenue because my formula uses the last 4 quarters of revenue, which everything monies can't. That's why I have it in here. If you adjust the revenue, you see the assumptions drop. So it's actually not a buy now on the middle assumptions with a share price of 7 and a 15% return. On the high assumptions, though, it's still a freaking buy. So overall, the reason I bought this stock is, number one, it's a speculative investment. $500. I don't care. The stock's been freaking hammered. And I have this weird attraction. You have mysterious attractions. I have this weird attraction to stocks that have decent fundamentals and that are going to be needed but are temporarily depressed based on stupid politics or viruses or whatever. That's my thought process with GEO Group. I think they're going to be able to refinance their debt. I think they're going to find somebody. I think we need private prisons to help, and not even just private prisons, but even the assistance of private contractors, because even in the military, we use private contractors everywhere, okay? They're very helpful. It doesn't mean it's inherently bad just because there's private contractors. There's still a role for them, even if you think for-profit prisons are so bad. I think all this crap is going to blow over, in my personal opinion. But I could be totally wrong. I really could. And if you don't like the risks, and there's a lot of freaking risks, 26% of their revenue is at risk of going bye-bye. Massive freaking debt. Issues refinancing. Stocks been down. A lot of people don't like stocks that go down. There's a lot of risk. So it's really up to you whether you buy this stock. But I put $500 into it. If it goes up, cool. I made 15% over the next 5 years. If it doesn't, whatever. I maxed my tax advantage account, so I don't care. That's my thoughts. Anyway, like, subscribe, tell your friends about me, and you have a wonderful night. Choo!